Hello everyone. Welcome to our webinar on keeping FX trading simple. If you can hear me, please type a yes on the chat so I know everything's working. Okay, thank you, Sam. Thank you. Thank you, Sui. Thank you, Ben. All right, so great. So let's begin. My name is Kenneth. I'm currently the head of FX CFDs, and the objective of today's webinar is to share the basics of how to get started with FX trading, and also to share a secret recipe to keep it simple. So remember, in this webinar, we are actually training you to think for yourself so you can trade through anything. Yep. So, okay, the usual disclaimers apply. Most importantly, this presentation does not constitute a trade recommendation to buy or sell FX CFDs. Yep. This webinar is actually a sequel to the webinar previously held by my colleagues, Sam and Onisha, where they introduced the foundations in FX CFDs. So if you missed it, the above is a link to the recorded video, or you can simply find it on our PhillipCFD webpage. Yep. So today's content outlines are as follows. If you are still sitting on the fence as to whether to add FX to your portfolio or to trade FX, I'll first spend about 10 minutes to try to convince you that you should. Then I'll do a quick recap of a Forex trade, which was covered by Onisha in the previous webinar. This round, it will be shown in terms of the components of a typical Forex trade. So if you understand all the components, meaning all the components of the Forex trade, it means that you're ready to trade. Then we'll move on to answer how to trade, which is the secret recipe that we'll be sharing. Okay, do you know which of the world's largest, most liquid and active financial place? Which is the world's largest, most liquid and active financial place? I would invite all of you now to type FX in the chat. As there's no question about this, it will be FX. Great, thanks, Sam. So the average global daily trading volume of the Forex spot market dwarfs the volume of the stock market. Yeah, this is only because everyone has an essential need for foreign exchange, as attested by the diverse participants in the FX markets, as you can see on the chart. Now, more importantly to you, what is the implications of such liquidity? Well, more participation means more buyers and sellers. So this in turn means better price discovery and also lesser situations of price gap, as you can see from my chart comparisons below. For the same 1-minute charts based between a high volume stock like Singtel and a euro-dollar FX contract, you can see that pricing gaps are more significant on trading Singtel. Now, liquidity in FX therefore makes market manipulation of prices more difficult, as FX prices are subjected more to macroeconomic news versus company-specific news. Now, next question is, so which CFD contracts offers the lowest transaction cost? Again, please type FX in the chat, as that's the answer. Yes. So you can, in common forms of trading, the basic components of trading costs are commissions, financing charges, platform fees, market data fees, and bid-ask spreads. You can see from the FX CFD column, Phillip charges 0 commissions, no financing charges, no platform fees, and no market data fees. What you see on the prices is what you pay, and we have very competitive prices for FX CFDs. Now, some of you may ask, why is bid-ask spread a transactional cost? Well, that's only because when you enter a trade, eventually you will have to exit the trade to lock in your profits. So the cost of this round trip transaction will be what we call the bid-ask spread cost. Now, the table here is to prove using statistics for the same contractual value, in this case, using a US dollar 100,000 value of contracts, so that you can compare apples to apples. The bid-ask spread will cost you the last column, which you can see, with the header spread cost in US dollars. You can see that for FX CFD contracts, because the spreads are so competitive, the round trip cost, remember getting in and out of trade, the round trip cost of getting into and out of trade is the lowest among other instruments. Phillip CFD offers FX CFD at ultra competitive prices, and for the majors, it can be as low as 0.3 pips. Yep. last did you know question. So which CFD contract offers 24/5 continuous trading, meaning there's no trading breaks with session hours. It's just continuous trading through the whole day for 5 days. Once again, please type FX in the chat. And yes, so FX, all these are advantages of FX. FX CFD offers you the ability to go long or short 24 hours a day, 5 days a week. So it's unlike the stock market where liquid hours are usually the opening and closing hours, and the futures market is where there is higher participation around the opening hours. FX market's liquidity is derived all through the day. So this is because FX follows the interbank market, and as it is an essential instrument that everybody across the globe requires, there is huge participation at all hours. So this also means you can use FX to manage your foreign investment exposures to currency risk at any time of the day. So in this, there's a separate article that we prepared. I think we will paste the link in the chat as well, so you can refer to. We explain the importance of hedging FX risk for investors investing in overseas assets, because FX exposures can actually swing your profits in overseas investment to losses. So you can read more about this. You can find the link to this article at the top, or simply visit our PhillipCFD webpage as well, or the link is actually in the chat. So now, for the second part of this presentation, we will now talk about the typical Forex trade. For those with a CFD account activated in Poems, you can get to the Trade tab for FX in 3 simple steps. Step 1, click on CFD tab as shown in Poems. Step 2, click on the drop down and select FX so that you get to see all the available FX pairs we have to offer. And step 3, double click on the contract you wish to trade. Example, Euro USD FX CFD. And that will bring you to the Trade tab. Here you can see the bid, the ask, the spread, the order type to be selected, the quantity, and the action of buy or sell. So once the trade is established, you can see its done status in the same order status panel in Poems. So as simple as that, you get access to FX CFDs. Now, how I would like to explain this typical Forex trade is through the detailed statement that will be sent to you once the trade is done. You can see the upper portion of my my screen here. That is what we derive as a statement that is sent for every done trade. Yeah. For this particular case, this is a typical statement sent for done trade in AUD USD, which I'll come to explain it later. Aussie against the US FX CFD for a short position. If you understand all the components shown on this statement, means you are ready to trade. So as this is a recap from my colleagues in the previous webinar, I will move a little bit faster so we can get to the secret recipe faster. So for FX, these are traded as CFDs, contracts for difference. Just to recap, CFDs are a derivative product of the main underlying interbank FX spot market. It's traded over the counter, and you are participating in the price movements, but not actually owning the underlying. It's a contractual agreement where the counterparty to a trade is Phillip, and once you exit the trade, the profit and loss is to settle the difference between the opening and exit prices. So what is Forex trading? Now, I would like to invite you to type into the chat some countries that you have visited before. Some countries, like for holidays or, Japan, Hong Kong. Thanks, Sam. Anybody been to Australia, maybe? Malaysia, great. Yeah, so, yes, so whenever we visit another country, we will have to use the foreign country's currency to pay for things. So think of it as going to the money changer to buy the other currencies, to buy the other country's currency. So example, at the money changer, you wanted to go to Japan, you will buy the Japanese yen and pay for it with your Singapore dollar. Think of paying for it as selling the Singapore dollar to the money changer. Now, FX trade works the same way. There is always 2 currencies involved, and the action for one currency is to buy, and the action for the other currency is to sell. So, now, referring to the first component called trade date. As we mentioned, FX markets trade 24 hours, but each country's day could be different. So over many years, FX market has established a convention. Remember, in the past, US dollar is always the king. So where the trade date shown on your statement will always follow an end of day trade date, and this actually follows 5 p.m. New York time. Okay, so if you trade past midnight at 1 a.m. tonight, so Singapore's date is already 1 a.m. 18th of July. But for FX trades, they are still following a trade date of 17th July. Now, the trade date change over to the 18th will only happen at 5 a.m. Singapore time, which will coincide with the 5 p.m. New York time that we're talking about. Yeah, so this clarifies why the trade date, sometimes when you're actually trading past midnight, is still the previous day's trade dates. Now, very quickly, FX symbols. Forex currencies are always quoted in 3-letter codes, as you can see, as they are always traded in pairs. So in FX CFD contract name, you'll always find a pair of 3-letter codes as shown in the statement for AUD USD FX CFD contract. So as you can see, the abbreviation for British pound is GBP, Swiss franc is CHF, Australian dollar is AUD, and of course the US dollar is USD, and the rest of it is actually shown on the slide as well. Yep. So for the pair of currency, now, for the pair of currency, the first 3-letter refers to the base currency, while the last 3-letter refers to the term currency. Remember, we're always paying or receiving in terms of the other currency. Using the money changer concept, think of it as buying 1 unit of the base currency by paying for it in terms of the term currency. So for action, when we buy or sell the FX CFD contract, we are actually buying or selling the base currency. The action refers to the trade action on the base currency. So an opposite transaction naturally takes place in the term currency as you are paying or receiving in terms of it. Now, coming to the price code itself, the price code is therefore very easy to understand. As you can see, if the euro dollar is quoted at 1.1100, this means that 1 euro dollar can be exchanged for 1.1100 US dollar. Now, for the GBP against USD, which is the British pound against the US dollar, if it's quoted at 1.28, so this means that 1 pound can be exchanged for 1.28 US dollars, and so on. So for the Aussie, AUD USD, if it's quoted at 0.67809, this means that 1 Aussie can be exchanged for 0.67809 US dollars. And if the AUD USD rate goes up, this means that 1 Aussie can now buy more US dollars. Instead of buying the 0.67809 US dollars, you can now buy 0.69017 US dollars. Yep. So I would want to draw your attention to the table below. Now, to calculate profit and loss, whenever we buy or sell the contract, it always refers to the base currency action and amount. For this case of the position on the statement, we have to remember we sold Aussie 10,000, and if we are to exit the position, we will be buying back the Aussie 10,000. As you see on the table, the net Aussie amount will remain as 0 Aussie. However, the US dollar that we receive and thereafter paid will determine the P&L. In this case, the position is short AUD at 0.67809, and the prices went higher, so the position is losing money. Because when you sell something, you hope for its rate to go lower. Now, the market price at the moment is 0.69017. So if the investor was to exit the trade, he'll need to pay 6,901.70 US dollars for the same contract, and that represents a loss of $120.80 in US dollars. Yep. So please remember that when you want to sell a contract, you are actually selling at the market's bid price, because that's what other investors are willing to pay for. When you are buying at a market's offer price, because that's what other investors are asking for. Okay, so lastly, the quantity that you trade is defined as follows. A standard lot is 100,000 of the base currency, while a mini lot is 10,000 of the base currency. So in poems, the quantity value that you key in the box on quantity is referring to the number of mini lots you want to trade. You can see 1 by 10,000. So it's 1 lot of mini. So in poems, yeah, so that's in poems. The forex market trades on margin. So this means that the trader is able to use leverage to take on positions while using a smaller initial deposit. You don't actually have to fork out 10,000 Aussie to actually trade this. So you only have to put up a smaller margin. So please remember, leverage does not equate to high risk. Poor money management equates to high risk. And leverage is actually an advantage as the investor is able to free up capital for other investments. Great. So now we have come to the recipe of success. We'll first talk about the overarching principle before narrowing it down to the strategy of a trading plan. And the recipe is this. Keep it short and simple. Now, short here doesn't refer to doing short-term trade, but it means don't fall into the trap of hanging on to a wrong trade or by doing what investors call averaging on your losses. That is to keep any losses short while letting your profits run its course. So that is a principle. Now, simple means do not overcomplicate your thinking with excessive use of analyzers. Just keep your trading simple. This is especially so for beginners, as often beginners, there are two main categories of them. One category is doing way too much, putting in so much indicators in there that they are completely misguided. As you can see on the left, if you overcomplicate your process, you can actually make it harder on yourself to learn and improve. And still, after all these indicators, you will still not know whether to buy or sell. Well, the other category of beginners are those that simply does nothing, not knowing how and simply staying out of trades. And after that, complaining about missed opportunities. So before we look at designing a trading plan with the KISS principle, let's understand the three types of market structure. An uptrend or bull trend refers to higher highs denoted by HH and higher lows denoted by HL. So if the price action is doing higher highs and higher lows, we say that the market is on an uptrend and we would like to buy the contract. Now, vice versa, if the price action is doing lower highs and lower lows, we say that the market is on a downtrend, also known as a bear trend, and we would like to sell the contract. Now, lastly, there is a consolidation range where the market is on a sideways trend with almost equal highs and equal lows. The key in trading these market structures are therefore in identifying potential trend changes and catching the trend early. Now, this is easier said than done. We don't want to catch a trend too early as it might be a false indicator, and we don't want to catch a trend too late because by that time, the trend might already be losing momentum. So let's have a practice scenario. Let's take this example of a USD against SGD, which is dollar against the Sing dollar, daily chart in 2022. Now, starting from the low denoted as the letter L, this happened to be around early February last year. You can see that the dollar Sing FX pair did a series of higher highs and higher lows. Now, I've covered up the price action after the price established what seemed like a potential reversal, having broken below the previous higher low to establish a first lower low. Now, those who think that the dollar Sing will continue to go lower because it has broken from the uptrend, please type a down in the chat. Those who think that it will go higher, please type an up in the chat. So who thinks up? Okay. Any others? Up too. Good. Thanks, Ben. Up as well. Great, great, great. Great. I guess you guys are all very astute investors. Very hard to bluff you guys. But even though that the price action actually have broken below the higher low line, it does not immediately indicate a potential trend reversal. So instead, the price actually did go up, as you can see, and what has been identified as a breakout from the higher low trend line to establish a first lower low is actually wrong. So instead, the points should be identified as such, where the higher highs, the lower low was not established. Instead, it was actually established as the next higher low, and then the market continued to trend upwards to the new higher high. So in this example, what I'm trying to show here is that leaving it to a subjective feeling of where the points are or what the trend could be could go drastically against you. Instead, using an indicator would offer a more consistent approach to your trading plan. Again, this is part of keeping trading FX simple. So let the indicators do the work for you. So for the example, taking the gold chart, if you use an indicator called the SMA crossover, SMA stands for simple moving average. So for SMA 20, it simply means to use the last 20 prices, sum it up, and divide by 20. While the SMA 50 means to use the last 50 prices, sum it up, and divide by 50. You can see that the SMA 20 is more reactive since it's the average of the last 20 days. We call this the red line. We call the red line the faster moving average or the faster line, while the blue line is a slower moving average or the slower line. Now, when the SMA 20 cuts across the SMA 50 from the bottom, the indicator is suggesting that the average prices based on the recent 20 prices are starting to move above the average prices based on more points from the past. So this takes a subjective identification of higher highs and higher lows to become more of a method based on statistics. So as you can see, the gold prices then started on an uptrend following the green arrow. And when the red line cuts the blue line again from the top, it's suggestive of a downtrend and so on and so forth. So this is one form of indicator that we can actually use. Yep. Now, in designing our trading plan, keeping in mind the KISS method, there are 3 steps to follow. One, we design a trade strategy, just like what we did in the previous slide. So we do this by firstly designing on a time frame that suits your trading style, using an indicator to identify new trends. Remember, the key is about identifying new trends that's coming up. Not too late, not too early. Using an indicator to actually confirm that it's not a false trend. Then we plan simple exit strategies, and we test the strategy thoroughly on past prices. Step 2 is actually we define the risk to undertake, and step 3, we review the performance on historical chart data. So now, let's deep dive into an example of a trading plan for euro dollar. So in step 1, we chose the 4-hourly chart. This is just an example. So each candle is actually 4 hours. Now for the indicator that we will be using, the SMA crossover as we have just discussed. For the other indicator to confirm the trend, we'll be using the relative strength index, which RSI for short. There are 4 main zones on the RSI, as you can see in the picture. Levels above 70 indicates that the contract has been overbought, while levels below 30 indicates the contract has been oversold. Now, level 50 is the neutral line. So between 50 and 70 indicates that the market has more traders buying than selling. And we call this the buy zone, while RSI between 30 and 50 is the sell zone. Now, the plan for entries and exit are simple. Now, if you can take a look at the green box, the plan for entries and exit for a long trade setup on euro dollar, that means to buy, SMA 20 must cross the SMA 50 from below. The RSI must be between 50 and 70, and therefore we enter a long euro USD trade. So we buy the euro USD. Then we exit the trade when the RSI is greater than 70 or when the RSI turns below 50, that means turns into the sell zone. Now, on the opposite side, we will do a short trade setup where the SMA 20 crosses SMA 50 from above to below. The RSI is between 30 and 50. We will enter the short euro against the US dollars. Then we will exit when the RSI is lower than 30 or when it actually turns above 50, that means turning into the buy zone. Now, how does this look on the chart? So as you can see, the strategy appears to be working. You can see that under #1 identified, where a buy is signaled, the entry was at 1.1765. And when the RSI reached overbought levels at 70, the exit would be at 1.1790. This trade would have made 25 pips. Now for #2 identified, a sell is signaled when with an entry at 1.1820 when the SMA crossover from above. Now the exit would be when the RSI reached oversold levels at below 30, as you can see, and the exit was established at 1.1770. And this could have made 50 pips. Now for #3, a buy was signaled at 1.1590 when the red line crossed above the blue line. However, because the RSI dipped momentarily below the neutral level to the sell zone, the position would have exited at 1.1570, and this would have resulted in a small loss of 20 pips. Now, even though the prices moved high, so it would have resulted in a small loss of 20 pips, even though the prices actually moved higher after the exit. So this backtesting results is suggestive that the exits based on RSI seems to be too early all the time. So instead, let's improve this strategy and adopt a firm stop loss at 50 pips while taking profits at a fixed 100 pips. So let's review this and make this tweak on the strategy based on the first backtesting results. And we will see that after adopting a fixed stop loss and take profit, we are actually exiting the identified positions less early. And in this case, and in this particular case, it works to allow the take profit levels to be at 100 pips for all three identified entries. I'm not saying that it will always be like this all the time, but I'm saying that this is how we actually review by identifying where you actually enter and exit on historical chart and how you can make tweaks to your trading strategy. So once we have identified the trade strategy, now it's time to define the risk. So it's very simple calculation of what position size you should take for each trade. For example, if you started with a capital of 10,000 and you plan to risk 2% of your capital on each trade. So in other words, for each trade that you get stopped out, in this case, you have a fixed stop at 50 pips. The drawdown on your capital will only be 2% of 10,000, which is $200. So you take $200 divided by the rate where you stand to lose, which is the 50 pips. In this case, is represented as 0.0050. The position size that you can afford to take will be up to 4 mini lots or 40,000 euro against the US dollar. Lastly, when you have a strategy in mind and you're aware of the risk involved for the trades that you're doing, you should build a journal, whether it's in the form of pictorial screenshots or simply writing down a diary, as this helps you review and improve on your trading strategy. Yep. So finally, we have come to the almost the end of the webinar. Getting started. I would say now is the best time to get started on FX, as we are actually running an FX promotion for you to try it out. So where you stand to win up to $360 cash credits if you trade FX CFDs. So how this promotion actually works is as follows. If you execute 8 FX CFD trades within a month, you stand to get $20 cash credits. If you execute 28 more FX CFD trades, you stand to get $100 cash credit. So there's $120 to be received each month, and we are running the promotion for 3 months. So yes, get your hands early on this, and you can really try it out and take advantage of the promotion as well. Yep. So we have come to the the link is actually on the chat as well. To learn more about our FX CFD promotion, please do refer to the link. There are more details up there as well. So we have come to the end of our webinar. Thank you for all your patience. Yes. So we are welcome to take any questions. Any questions for anyone? All right, Jay, can FX CFD be used to hedge foreign currency fixed income? Example, US Treasuries. Oh, I would say yes, definitely. Whenever you actually make an investment in a foreign currency based asset. So for example, you were asking foreign currency fixed you were asking example, a US Treasury. You as a Singapore investor would therefore be exposed to US dollars. And as you have known, the dollar sing rates actually crashed drastically in the later parts in the earlier half of this year, especially when the dollar sing got sold off. So if you were holding on to US Treasuries, it means you're actually holding on to US dollar assets, and therefore you're exposed to US dollars risk. When US dollar starts to come lower, and in our terminology, it starts to depreciate, then you might not be actually getting the most out of your investment, because when you actually change back to Singapore dollars, you will be at a disadvantage, if I put it that way. So this is actually explained in further details in the article that we were showing. Just give me a moment. Yeah, this is actually explained more in the article that we put out. Yes. So in this article, I tried to explain why does hedging FX risk matter to you. There, we actually show a tale of two cities in a way, in a story kind of way, where one of the investors actually invested in Amazon. Amazon prices actually rose, and he thought he made a profit of 7,000. But when he actually converted back to Singapore dollars, he realized that instead of making that $7,000 profits, he actually made a loss of close to 2,000 Sing dollars. How come? So this article will actually explain more on that. That actually hedging FX risk matters to anybody who actually does overseas investment. Yeah. Any other questions? So yes, FX can be used for both speculative trading as well. A lot of people, especially physical hedgers and those who are really actually exposed to whether it's US stocks or assets based in other currencies, they actually do lots of hedging in FX, because what they want to do is they want to focus their expertise on analyzing prices based on assets and not be exposed to something that they are not aware of. Yep. For treasuries, do you need to hedge every single future coupon payment? Well, it really depends on how large you actually trade on the treasuries. I would say in terms of the contractual value that you first put in or invested in, you should actually hedge that big value. For the future coupon payments that you are actually receiving back, because you can, but that you have to understand that there's a series of trades that you actually have to do as well. So it really depends on the size and the frequency of these treasuries that you're actually receiving a coupon payment for it. We have maintained our FXCFD as very flexible contracts. So again, you can actually hedge it very diligently, as well as you can actually take a view on it. So a lot of people actually mix speculative trading along with hedging needs. They actually hedge their hedging needs, but on certain cases or short-term basis, they know that they have immediate needs for it, but they are not afraid to actually speculate on the trend as well. So even if the pair goes against them, they already have the need for it, so they don't actually have to square it out. Yeah. So I hope I answered that question. Yeah. So yes, do try out our FX CFDs for you realize how flexible it is. Again, as I mentioned, FX trading happens 24 hours a day. So anytime you get into the trade, whether it's in Asian hours, whether it's in the London hours, whether it's in the nights when you actually decided to, yes, I need to get into this US share, do remember that, hey, you are actually exposed to US dollar exposures. So you can hedge the US dollar against the Sing at any point of your trading day as well. Yeah. Okay, I guess if there's no further questions, I'd like to thank everybody for attending this webinar. Do check out the links that we actually provided, and please take advantage of the promotion that we are actually running for the next 3 months. So yes, it really will give you a head start to your FX trading experience. All right, thank you. Yep, thank you. I shall end the webinar now. Thank you.